Tuesday, April 18th, 2023, Maneco 64, home of alternative economics and contrarian views. Back in 2006-07, very few people had heard of subprime mortgage lending. And when that market started going south, people didn't think it would affect the major mortgage markets, or the economy for that matter. It was even Ben Bernanke who said that the subprime mortgage crisis is contained.
He went on to talk about the subprime market. Another fear yesterday was that there'd be contagion, but not in the eyes of Ben Bernanke.
Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy, and the lending side of that still seems to be healthy. Overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008 to a rate close to the economy's underlying trend.
And I think we have now something similar evolving, and it's commercial real estate market. I think it could be what one might want to call a black swan, or a trigger for a bigger crisis, for a deep recession. And we have some news in the last few hours here in the FT, and it concerns the California State Teachers Retirement System, or CalSTRS. And this is what the article says. Pension fund CalSTRS braces for write-downs in $50 billion property portfolio. Warning from $306 billion fund is latest sign that higher interest rates have upended U.S. commercial real estate market. So let's quickly go through this article, and I'll make some comments along the way, as I usually do. So it says here, one of the biggest public pension plans in the U.S. is preparing to write down the value of its $52 billion real estate portfolio in the latest sign that higher interest rates and the recent turmoil in the banking sector are causing pain in the property sector. So I guess one thing we can do is extrapolate that this pension plan is not the only one that has expanded into real estate. So we need to keep that in mind. It's not just a problem for CalSTRS. The $306 billion California State Teachers Retirement System has plowed an increasing share of its assets into real estate in recent years in the bid to diversify away from stocks and bonds and benefit from the superior returns on offer to buyers of private assets. Private assets, keep that in mind, they're not as liquid. Well, it's too bad they didn't diversify into physical gold and silver, but they're probably not allowed to because gold and silver are too risky. Not. But the fund's chief investment officer told the FT that he was now bracing for write-downs in the value of assets in its property portfolio amid growing evidence that the Fed's rapid monetary tightening over the past 12 months has knocked valuations in the sector. Well, I would say, yeah, it knocked it last year, but you'll see why they're only reacting right now. Office real estate is probably down about 20% in value, just based on the rise in interest rates, Christopher Ailman said. So you do the maths, 20% of 52 billion, you know, that you're talking about almost 15 billion write down, which is huge. Our real estate consultant spoke to the board last month and said that they felt real estate was going to have a negative year or two. CalSTRS is not alone in its worries. State Street Chief Executive Ron O'Hanley told the FT on Monday that the U.S. custody bank's biggest concern was what happens with commercial real estate, particularly offices. He predicted that commercial real estate woes would contribute to a gentle slowdown in the U.S. economy. For CalSTRS, the concerns about property mark a departure for one of the fund's best performing asset classes. Real estate had provided double-digit returns over a 10-year period for the 1 million member plan. According to an update in March, it reported an overall 6.7% loss across its entire portfolio in 2022, in a year that saw both bond and stock markets suffering heavy losses. Real estate makes up 17% of CalSTR's overall assets. Its holdings include a $240 million investment in 300 West 6th, a 23-story office building in Austin, Texas, and a $1 billion holding in the Blackstone European Property Fund. I've spoken about Blackstone. I've been speaking about these funds since December, and they're like privately held funds as well. And that Blackstone had stopped like people withdrawing their money, and it's not over yet, folks. It's continuing. Offices have emerged as a key worry for the global real estate market as the combined impact of rising rates, the shift to hybrid working, and pressure to upgrade buildings' energy efficiency hits landlords. And this is interesting here. The head of CalSTRS was saying they see a 20% loss so far. It says here U.S. office values could see peak-to-trough falls of about 30%, according to a forecast by consultancy Capital Economics, while prices in the worst hit cities like San Francisco could have. So I think they're being a little bit conservative there. Real estate is generally slower to reprice than other assets because it is relatively illiquid. The lack of deals in recent months has given valuers less evidence for the true price of buildings. So it could be, it's really, it could get even worse. We could see what happened in Japan in the late 80s, early 90s, where properties lost 90% of their value. It's not out of the question. That would be disastrous, of course. Ailman said he was cautious on the outlook for property, in part because of the risk of a sharp downturn for the U.S. economy. Sharp downturn. I agree with him. While a recent decline in inflation had bolstered his confidence that the Fed could pull off a soft landing where it manages to tame inflation without inducing an economic slump, there was an equal chance that we're still headed to a severe recession, he said. Ailman said the fund was a long-term investor and would avoid selling property assets into a falling market. If you have long-term leases and solid debt financing, you just hold, he said. Your office portfolio has fluctuated in value before. You continue to get income. So yeah, that's the idea here, to get income, because of course they're running a pension fund and they have retired teachers, of course, that have to get an income. But how long do you hold on for? How long do you hodl these commercial real estate investments? Are they going to stabilize? Is the Fed going to be able to keep rates at the levels that it currently is? Is it going to increase it a bit more? Will it really have to keep increasing it? Is the inflationary pressure over? I don't think so. We're seeing commodity prices starting to go up again. And again, it's not commodity prices that are going to create inflation. It's the consequence of inflation. I don't think the inflationary problem is anywhere close to being over. I think bond yields and interest rates are in a secular new secular cycle where interest rates are going to keep rising. Yes, they will fall sometimes, but the general trend for the next few decades will be higher rate. It will be harder to borrow, and we've just seen too much malinvestment, too many malinvestments in the last 20, 30 years, because interest rates, aside from being in a secular bear market in terms of rates and bull market in terms of bonds, have been artificially manipulated by the central bankers through QE. And I think that is coming to an end, and it's going to be really tough. So yeah, keep an eye on commercial real estate. And it's not just in the US, it will affect the whole world. We saw subprime mortgage problems started in the US, and it rippled through the whole world banking system because a lot of investors from abroad were involved. And I wouldn't be surprised that the same hasn't happened with commercial real estate. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.